You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Well, hello, everybody. Welcome back to the podcast. Hope that you've had a great week with your loved ones. So people might be wondering out there, what's the best policy for infinite banking? Now, there are lots of different types of policies available out there, and a very popular one right now that people will sometimes think or promote to do infinite banking with. I know that if you are a regular listener, you've heard me say more than once that a dividend-paying whole life policy is the best policy for the process of infinite banking and from a mutual life insurance company. Because if it is from a mutual life insurance company, that company will pay you dividends as they see you as an owner of the company. You are co-owners of your policy. Now, another popular policy out there right now is universal life contracts. There are different types of universal life contracts, and right now it's very popular. The index universal life is the most popular, and they even are making changes to those types of contracts. So they created universal life, and then that they decided wasn't great because people were doing better in the stock market, interest rates were high. So they changed it, or they brought in a new type called variable universal life. And then that was doing okay until it wasn't. And then they changed, or they brought in a new type because they still have all these other existing types. But the latest one is index universal life, which is very popular right now. And a lot of people think that that's a great policy to use for infinite banking because it has a lot of flexibility. You can be flexible with the premium, really, meaning you can even skip your premium payment altogether. You could go a year without paying your premium payment, or longer, or just a few months. It really depends on how much cash you've built up inside of this policy before you're able to skip premium payments, but people like the flexibility of not being required to pay a premium payment if there's a hardship. Whereas whole life policies, you will be required to pay the premium. There is some ways to be able to pay that premium if you have a hardship, as I discussed extensively in my last podcast. However, you can't just totally skip it altogether and pay nothing. Now, when they do that for a universal life policy, there is still a minimum cost being paid. It's just coming from your cash value, and it does not create a loan, and you don't need to pay it. It doesn't create a loan, and there is no requirement for you to pay that premium at that time or in the future. You are able to just skip it so long as you have cash in your policy. Now, again, the reason I don't like these types of policies, a universal life for infinite banking, is because they do have increasing costs. And as you age, they will go up in price as far as mortality charges, and that will take away and eat away more of your cash value inside of your universal life policy. And so that when you are older and hoping that there is cash there for you to use in your retirement years, there may not be as much as you were expecting or any at all. In fact, you may have to pay an increased premium than you've been paying all these years or all the years before retirement to even keep your policy and to keep it in force for the death benefit. Oftentimes there is no cash, at least in the people that I've helped as they've been orphaned. Their agent left the industry and they were sent over to me. Yeah, if you have an agent and they leave the industry, then they call that an orphaned client. And then they will, when that person calls in or needs help, they will send that client over to someone new to help them. And so I've received numerous of these types of clients and have seen how in the older years, after they've had their policy for decades, what actually happened, they didn't have any cash. And a lot of times they're very surprised and wondering, why is my premium going up? It's because the cost has been going up. The older that the person gets, the older that you get, the older or the higher the costs raise, because the older that you get, the closer you are to passing away, the more likely they are going to have to pay that death benefit. And so the higher the costs, because it basically functions like a term insurance inside of the contract. the older you get and the closer you come to dying, the more they have to raise the price because they haven't been charging you very much in your younger years. And that's how term insurance policies work. I just helped a client recently who has been paying a very low premium, around $150 a month. And their premium was going up to something like $800 a month because their 10-year term had expired or it will be expiring. And so, of course, that person was like, whoa, I don't want to pay that $800. What can I do? What are my options? And so at that time, your options really would be to convert the policy to a permanent contract if you are within the age limits of being able to do that, or apply again. And hopefully, if you're insurable, then you can acquire another contract. But that's why I like to use term to be able to convert when I'm older, because I don't know what my health is going to be. And the younger I am and acquire term policies when my health is young and I am doing well, then I get to keep that health rating when I'm older and wanting to convert that to a whole life policy to grow my system. Because to grow your banking system, you're going to want to fund more and more and more into premium dollars. You're going to start with one policy, and over time, more than likely will end up with more than one, because you can only fund so much into one policy. You can't put too much money into the contract, remember, or it will become a modified endowment contract. It will MEC and it will be taxable. And also keep in mind that you will have to drop off that paid up additions rider as you age, and depending on the structure of that, maybe sooner than later. So if you have one of those really tight policies where you have very, very low or very small minimal base premium, which a lot of people out there are promoting, say 10% into the base and 90% into the paid up additions, and that's pretty close to the MEC line, and you're not likely to be able to fund that paid up additions for very long. So building it with more of a buffer, you would at least be able to pay that paid up additions for a longer time period and keep it from the risk of MECing later on down in your life when your policy has grown and you have earnings inside. And now if the policy were to MEC in your later years, then you may have a big fat tax bill on your hands. So we don't want that to happen. We want to make sure your policy is built well and with enough of a buffer so that you're not going to MEC your contract in your lifetime at all at any time. So now back to the type of policy that you would want. I do see that universal life policies are making little tweaks here and there to try to make them better and more appealing, because that is a really popular contract right now. But no matter what, I still don't like the increasing costs inside, and that the fact that the company can raise the rates on your existing contract, even at your same age, if they need to. If they see that the contract is not going to be earning enough, they can simply raise the rate at your age for any person at any age within that bracket. And so then, in addition to the price automatically, or the mortality charges automatically increasing as you age, there also is the risk of them simply being able to increase the mortality charges on that age bracket anyway. So you have the flexibility with Universal Life to pay the premium, not pay the premium, pay in more into the premium, and you have that flexibility to kind of fund whatever you want, sort of. You still have to watch the MEC line. With whole life policies, you do have different timeframes you can pay the policies. There are 10-pay policies, 20-pay policies, although I don't see those as much with companies I'm working with. I work with a company that has a product that you can pay, that the premium will automatically stop after age 75 or 25 years, whichever is longer. But for the majority of contracts, for the most part, whole life contracts are to be paid your whole life until you're at least age 98 is what I most often see. And so you're either going to be paying that premium until you're 98 years old, or you're going to get one of these other contracts that the premium stops sooner than that. But keep in mind that no matter what type of contract you have, you can always discontinue premium sooner than later. You don't have to fund it all the way to age 98 or even to age 75. You could have a 10-pay with basically any whole life policy. You can fund it for just 10 years. I have people coming to me and asking if they can fund a policy for a short period of time, say 10 years or even less sometimes. And yes, you can do that. And if you stop the premium, the contract will be efficient. It will grow well into the future. The only problem is it won't have as much cash because you've put less in. So if you're funding it less, it will have less when you're older. the contract will grow cash efficiently and all that will be great. It just will have less cash because you've put less in and you have less that's being guaranteed to grow and less that's helping you buy dividends or receive more of the dividend. So it's just going to be less cash. And so someone who is on the track of, I just want to have a policy and just want to pay it for 10 years, usually then you'd want to start another one. If you're discontinuing premium on one of them, you'd want to start another one because you most likely still have cash coming in and funds that you need a place to put. Where are you going to put the cash? You're going to put it in your bank. You're going to put it in your investment account. Where is it going to go? But if you're able to funnel it through your life insurance policy, then you're able to do all sorts of things with it, finance the things you need, and do all sorts of things while it continues to earn and grow for you. So I think it's a good idea to have a place to put that cash if you would like to put it there, and to keep the policy premium going at least until you reach your retirement years, if you're able to, so that you have that money growing, working, and building for you and doing a whole lot more for you than it will be sitting in a bank account and you have access to it all the time, unlike in a retirement account with no penalty, just building efficiently for you for whenever the time comes that you might need it. So dividend paying whole life policies issued from mutual companies for the win when you're looking for a policy to start the process of infinite banking. Keep in mind and remember that Nelson Nash always said, it's not about the product. You could use any product. You could use a CD at any bank you want. You can bank under your mattress. The point is the process of infinite banking, what you're doing with the funds, and that you keep the money in motion, not just letting it sit there, but using it to pay off those outside debts, using it to pay off things that you are paying loans to other banks for, or any kind of debt, school loan debt, any kind of debt out there, or anything you're going to get in debt for. You need a new car. You're going on a major vacation. You're planning to pay for your children's school or to finance your next piece of real estate. Whole life policies are going to give you that stability that you're looking for. They're going to have those solid guarantees, the guarantee of your cash to grow as opposed to the guarantee of the company's ability to raise your cost, which is what is written inside of a universal life contract, their ability to raise your rates. That is what's guaranteed in the contract. Whereas whole life has the guarantee for your cash to grow. And as you're financing your next large purchase, don't forget to pay yourself back and with interest. And it's best to pay yourself back with interest that's greater than what the company is charging you. That will make your system more efficient and help it to grow better and help you to grow your overall banking system for you to have more wealth and more cash in your later years and for your retirement years. Well, that's all I have for you today. For those of you that listen all the time, you do know and hear me say regularly that whole life policies are the best vehicles for this process because of the guarantees, because of the solidness of the contract, because of the guaranteed growth on the contract, because of the ability to use those contracts for other things, such as critical need or chronic if you have a long-term care need. And eventually you will leave a tax-free death benefit to your loved ones, and that will be guaranteed as well to age 121. So those of you that are regular listeners know that this is how I feel about whole life, and not only me, but the Nelson Nash Institute. They are adamantly against using anything but a whole life contract to start your banking system. So if you're out there and you're meeting someone or you're listening to one of the many TikTok, Instagram videos or things that are out there and you hear them talking about a different style of contract to use and how wonderful it is, yeah, it does sound wonderful. Even I thought in the beginning, oh, this is a pretty cool contract. But at the end of the day, there's a lot of risk to banking using one of those policies for the process of infinite banking. As always, if you'd like my help, if you'd like to work together, please reach out to me at valerie@alphaomegawealth.com. I hope that you found some value in this podcast, that it was a reminder of some things maybe that you've been hearing and learning and studying, and that it just helps to solidify some of those thoughts in your mind. And I look forward to sharing with you again next week. Take care.
This is thepodcastfactory.com.